Hello, everyone, and welcome back to the new Blueprint strategy course. Last week, we already covered a lot of groundwork. To watch last week's recording, you can just navigate into your classrooms, and you'll see at the very bottom OTC Blueprint, including Campus Indicators. This all-encompassing strategy course entails 3 major pillars or sub-strategies that put together in the right place will form the entirety of the Blueprint strategy. 1, supply and demand, 2, Campus Indicators, and 3, Campus Strategy Optimizer. You can just click on that. And here you'll find the course description. You'll find module descriptions. And as we add modules, there'll be additional module descriptions. And of course, you'll find lesson descriptions within each of those lessons, right? As well as the agenda here, of course, as well. More importantly, and this you'll only find as you're here within the modules, if you click on Get Notes, then for each modules, you will have module notes, okay? You will not have lesson notes, you will just have module notes. And within the module notes, you can download some of the slides that I perceive as important, as kind of cheat sheet slides where there's a lot of info in one slide and that you can just download, print out, and take some additional notes on, or just kind of put next to your TradeStation as a cheat sheet. Then what you also find as of today is, if you're new, there's a TradeStation account creation step-by-step guide. And there's the Campus Indicator download instructions guide. If you already expressed to subscribe to those indicators and you've been in contact with us, then this is where you would get the Campus Indicator download instructions. And as we go along, we will continue to add important notes here at the Get Notes function. So that's why uploading the recording took quite a while, because this needed additional coding and additional content creation. And now we have the infrastructure in place, so we can add each new recording rather quickly. It should only take 1 to 2 business days to then display the recording of today, for example. So what did we cover last week? We covered technicals versus fundamentals, right? We summarized that the technical chart analysis is objective and it's universally applicable to all markets and income goals. And technical analysis like supply and demand is very, very powerful for market timing. We said that fundamentals lack market timing, but they're much more predictive of when major market moves may take place in the future. And we concluded that fundamentals drive price. Then we said that a good trader combines the best of both worlds. A good trader is a good decision maker. They make future predictions based on a study of the past. They understand the fundamental drivers of the markets they trade. And above all, they are good money managers. Afterwards, we categorized all of our markets into finite markets and infinite markets and man-made commodities. And I shared an important table with you that works kind of like a cheat sheet for you to ensure you always apply the right fundamental forecasting tool for the markets you trade. What you may have found last week is that the key driver for all markets revolves around different institutional participants that are most active in each of our markets that we trade. So to understand the fundamental drivers of the markets we trade, we kind of have to understand the participants of the markets as well, especially the institutional participants. In other words, we really want to figure out how to follow the smart money. And this is what we are going to use as an anchor point to continue today's lesson. Trading 101, lesson 2. this so-called smart money that I keep referring to, these so-called institutions that I keep referring to, well, how powerful are they really? And more importantly, how good are they? But let's not get ahead of ourselves. As you can see here on this slide, Trading 101, Charts 101, and Supply and Demand 101, they're all lessons within the Strategy 101 that all revolve around key strategy concepts. They revolve around trading terminology, the language of professionals, and the language of your fellow traders, so we all speak the same language. We will look at the flow of money. We will learn about the flow of money, and we will learn about the participants of the financial markets. You'll also learn about the power of institutions and why we so desperately want to follow them. And in Supply and Demand 101, I will share with you our famous Warren Buffett case study, which will give us the key then to entering the next module. So as you can see, this first module really sets the scene. It builds a strong foundation and creates the necessary know-how for you to proceed into the next modules. All right, let's circle back to this so-called smart money, these institutions. How powerful are they and how good are they? What we need to answer this question is we need to put them into context of the financial market first. And after, we can then look at the power of institutions. This will be followed by the key elements that each trade has to consist of, the so-called set, followed by long versus short, which are basically just two ways of making money in the market, one with predicting declining asset prices and one with predicting rising or rallying asset prices. And at the end of this lesson, I already want to introduce to you an objective, measurable KPI that will in fact guide you throughout your entire trading life, which is the risk to reward ratio. All right, so these are all the topics that we're going to cover today. So there are 4 large asset classes. These include the Forex market, the stock market, the futures market, and the bond market. Now, the foreign exchange market, or the Forex market, is a decentralized market. So that means it does not have a centralized exchange or a specific market cap that you would have for stocks, for example. And therefore, what we need to do to rank the global markets by size is we can't look at market cap. We have to look at the average daily volume traded. Okay. And here we also just are getting some estimations, but these estimations, they're pretty accurate. So it is estimated that the daily trading volume in the Forex market is over $6 trillion US dollars per day. And that is making it the largest financial market in the world. But again, its market cap or its market capitalization, that's not easily quantifiable. But by sheer trading volume, average trading volume per day, the Forex market is still the biggest market worldwide. Actually, it's between 6 trillion to 7 trillion. Then the futures market is ranked at second place with around 1.5 trillion to 2 trillion of average daily volume. And that would include futures contracts traded on exchanges such as the CME, the Chicago Mercantile Exchange, or the ICE, which is the Intercontinental Exchange. Then at the far end, you have the stock market's daily volume. That's around 200 billion to 300 billion US dollars of traded volume per day. However, this number here I found can fluctuate heavily. it really depends on the market, and depending on volatility or market turbulence, this could be a lot higher, but it averages out probably at around 200 to 300 billion US dollars per day. And then bonds is kind of in between futures and stocks. That's at the third place in terms of average traded volume. And here it's estimated that the daily traded volume is around 700 to 800 billion US dollars. And that would include both government bonds and corporate bonds, and all bonds or bond markets around the world. So combined, looking at the four biggest asset classes today, there's an estimated 9.1 trillion US dollars. Okay, roughly, depending on whether you take the low estimation or the high estimation, but we can say an average of 9.1 trillion US dollar that move every day. Now, this money, this doesn't move out and it doesn't move in. This money just circulates every day. And we will come back to this concept of circulating money in just a little bit. Now, this will help us to put the institutional participants into the right context. And there are many, many, many institutions, right? There are banks, there are fund managers, there are asset management firms, and it's probably best to keep it real simple for now. So let us put them all in one bucket for now and just call them institutions. And some of the biggest and most widely known institutions you can see right here in front of you. You have, in fact, the top 3 asset management firms ranked respectively by assets under management. So you have BlackRock with 9.57 trillion US dollars under management. Then you have Vanguard with 8.1 trillion US dollars under management. And then you have Fidelity Investments with 4.28 trillion US dollars under management. At the 4th place, you actually have a Swiss bank, or also an asset management firm. They have 4.24 trillion US dollars under management. And then 2 other well-known asset management firms and or banks. In this case, they're both JP Morgan Chase and Goldman Sachs. JP Morgan Chase has 2.96 trillion US dollars under management currently, and Goldman Sachs have $2.39 trillion under management. That makes JP Morgan the 8th ranked in terms of assets under management, and it makes Goldman Sachs the 11th ranked. So Goldman Sachs with 2.39 trillion US dollars under management is not even within the top 10 of the biggest asset management firms worldwide. They're also mainly US based. Within the top 10, you have one Swiss, right? UBS, one Swiss asset management firm. Then you have a French one called Crédit Agricole or something like that. And then you have the German one, Allianz Group, which is both the French and the German ones. They are ranked 8th and 9th. But within the top 10, everyone else is US based, which kind of tells you a lot about the US market and Wall Street itself. If you look at the top 34 asset management firms, right? So if you had like a ranking of 100 asset management firms and you would look at the top 34, then all of those asset management firms have at least 1 trillion US dollars of assets under management. And if you were to look at the top 15 largest asset management firms, they now hold a combined total of 55 trillion US dollars in assets under management. Now, 55 trillion US dollars is pretty large. It's a large amount, and it can be difficult to grasp that. So let's put that into context, into some sentences that may make more sense or may even not, right? So here, for example, if you were to spend $1 million every single day, it would take you more than 148,000 years to spend 55 trillion US dollars. Okay. I hope to live 100 years. And here I would have to spend $1 million, 148,000 years. It's kind of still unimaginable. Okay. So 55 trillion US dollars is large enough, is a large enough sum to pay off the entire national debt of the United States, which was estimated to be around $31 trillion in 2022. The estimated GDP of the United States, the world's largest economy, was around 25 trillion US dollars in 2022. So 55 trillion US dollars is more than double the size of the US economy. And if you, I quite like this one, if you were to stack 55 trillion US dollars in $100 bills, it would reach a height of about 67,000 miles, which is more than 2.5 times distance from the Earth to the moon. So it would give you a round trip to the moon and back, and you would still have a couple of bills left over to do some further trips. Now, what does this tell us? Well, what this tells us is that if you look at any market around the world, like the gold market, crude oil, silver, natural gas, soybeans, S&P 500, Apple or Amazon, you name it, and you just ask yourself, why are these markets going up or why are they going down? Then you will understand, and I think it becomes very crystal clear that the only reason why any market is going up or down is because one or more than one of these so-called institutional participants are buying or selling in those markets. Now, this is an interesting slide. And it's so interesting because what you see here is basically a screen grab from the CFTC website and their data on the commitments of traders report. Now, the CFTC is the Commodity Futures Trading Commission. They govern the futures trading and they regulate the futures trading in the US. So what you can see in these reports, in these weekly reports, is pretty simple. It may look quite complex, but I'll make it really, really simple for now. Within this report, you have these so-called reportable positions. And institutions have to report their positions to the CFTC once a week, right? They're so large, they trade so many contracts that they are regulated by law to share their open positions within the markets that they trade. And this would be captured within this specific report under the reportable positions. Here you have the non-commercials and the commercials. We covered them last week very quickly in terms of finite and infinite markets. But to make it really easy, they're all institutions for us for now, right? And this would be based on contracts. And one contract is the equivalent of 100 troy ounces of gold is what we're looking at. And the screen grab is from January 17th, 2023. So what you'll see now is that, and don't worry if you cannot kind of read all of that, right? If this doesn't make sense. What this all tells you is that the commercials, they are currently holding 425,000 contracts in total as of the week of January 17th. And the non-commercials, they're holding 345,000 contracts in total. So combined, both institutional participants, the users and producers, and the fund managers, they're together holding more than 700,000 contracts, right? They're holding 770,000 contracts roughly. So if you were to put a dollar value behind that, looking at the contract value, and let's say that the current price of gold would be $1,800. I know by now it's probably more like $1,900, but let's just say conservative $1,800 per ounce, then one contract would be the equivalent of holding real gold that has a monetary value of $180,000. So holding in total 770,000 contracts that each has a value of $180,000 worth of gold, then institutions at the moment are reported to be holding 138 billion and 600 million US dollars worth of gold. Now, this slide is quite interesting to bring up already because it shows you two things. One is, hey, we can really track what the institutions are doing. Okay, this is a weekly report. Maybe we can't track them every single day. But what I will show you and what you will learn is to really take this report and look at not just this weekly report, but look at all the weekly reports going back years and decades. And what you will see then is how the commercials or the non-commercials are acting in the market. What do they do when the market goes up? What do they do when the market goes down? What happens at major pivot points in the market, right? What happens at major turning points in the markets? And therefore, this will allow you to understand the institutional trader a lot better. Now, we have an index that will make your life very easy. I just thought it was already interesting to show you the kind of data we all have access to, right? And to see what they are doing and to follow them on a weekly basis. And secondly, again, what I also want to say is, for everyone in the room here, it's very crystal clear the distribution of power in the financial market, right? It's not you and me or all of us little guys that would control the market. It's one or many institutions that have full control over the market, and that any market around the world can only go up or down if one or many institutions want it to go up or down. Now, this is our famous Goldman Sachs annual report of 2018 slide. And I'll also have an updated slide just after that. But for those of you that don't know the slide, let's quickly cover this as well. So what you see in this screenshot is you can see basically the daily net revenues or losses for positions that are included in the VAR. Now, the VAR stands for value at risk, which is a method that's used by these asset management firms to disclose and kind of quantify the risk of holding a financial asset. So in easy terminology, it indicates how many days of the year they were doing well and how many days of the year they're doing not so well. And it further indicates on the days they are doing well, how well are they doing? And on the days they are not doing so well, how badly are they really doing? Okay, so the first thing that really pops out here is that this is a beautiful bell curve. Just put this in here. Now, this bell curve, it indicates the normal distribution of their trades, right? So you can see that's the normal distribution of their trades. You can see that normally, statistically speaking, they are doing extremely well. Most of their trading days end with positive daily net revenues. In fact, they have 220 wins in the year of 2018, and they have 31 losses only in the year of 2018. Now, the further you go towards the left end and the right end, or in statistical terminology, the more standard deviations you're going to move, right? If you're going to move, let's say 2 standard deviations here, 1 standard deviation, 2 standard deviations, 1 standard deviation, 2 standard deviations, then the less likely it is for those trades to occur, right? So you can see on the left end here, in terms of the days that are negative, that are net losses, they are very rare. Well, they do happen, but when they do happen, they're mostly small, right? Calculated risk, that's small. And the days where the risk may be slightly higher, like here or here, they are very infrequent, right? They don't happen a lot. They are very unlikely to happen in terms of probability, statistical analysis, in terms of your normal bell curve. And then all to the right side, you have these standard deviations as well. And you can see the more profit that they're making, that they're booking on the day, the less likely these scenarios actually are, right? And that kind of makes sense. Now, what's so beautiful to see is that Goldman Sachs, right, they have one of the best trading desks in the world. They mostly have winners. So in percentages, they have 88% of their trades are winning trades, and only 12% of their trades are losing trades. And the winners, and here already transitioning or maybe seeding the KPI also risk to reward, on their winners, they have a lot more reward than they risk on average, right? So what do I mean by that? Well, if this was your 1x risk at 25 million US dollars of loss, right? If this was your 1x risk, then here they make a 1x profit, right? They are also making 25 millions of profit. And this happens more times than they lose, they win. However, this would be a risk to reward of 1 to 1, because for every $25 million they risk, they make $25 million, or for every dollar they risk, they make $1. However, here comes the interesting part. Now here, and that's their main business, right? They're making 2x. Now 2x on every 1x that they risk, this would be a risk to reward of 1 to 2, meaning that for every dollar they risk, for every $25 million that they risk on a trade, they're making $50 million. Now here, the story goes on. Now they're making 3x. On 56 trading days, they made 3x. So 1, 2, 3, right? For every $25 million they risk, they make up to $75 million. And the further you go, here they make 4x, or a 1 to 4. And here they make 5x, or a 1 to 5. Now, the interesting conversation that we should have here are really 2 KPIs that they're optimizing. They're the best of the best. They've optimized the win to loss ratio, which is 90-10 for them almost, right? And they've optimized the other KPI, which is called risk to reward, which is a lot more difficult to optimize, but is probably the key KPI that we need to optimize to do well in trading. And as you can see within their bell curve, they're making 1 to 2s, they're making 1 to 3s, they're making also 1 to 4s. And yes, they're making 1 to 1s as well, but they are mostly making more than one-to-ones, right? If you were to put all of these numbers together, then all of these combined, they're better trades than one-to-ones, right? And so they also are optimizing their risk to reward proposition. So we want to optimize both as well. We want to have an eye on the win to loss ratio. We want to have an eye on risk to reward, but on the risk to reward, we have a lot more leverage in potentially maximizing our profitability per trade, but we'll get into that later. Now that was 2018, and you may say, well, Jan, you know, okay, they had a good year in 2018, right? Who cares? I actually looked at their Q4 results of 2022. So this would be the latest results. And what you find are very similar KPIs. You have a win to loss of 86 to 14. You have 55 wins and only 9 losses. And the losses that they took, they were only small on those days, right? Mostly small. The biggest number here is 5, and this is the smallest risk. And what they did in the last 3 months, ended September, is they kind of optimized their profitability here on risk to reward even more so, right? Which is insane, which is most of their trades were extremely profitable. It's not just that they're winning more times than they're losing, but on every time they're winning, they're making at least 4 times as much as they're risking. And that is insane. And that is why they are the best trading desk in the world. Now, to point out here as well is, well, they're not always right? They have losers as well. And you can't be always right. And not even Goldman Sachs can always be right. And in fact, if you see someone claiming that they have, you know, an 80% win to loss ratio in their trades, then you already know, well, they must be working for Goldman Sachs, or it's very likely that they're full of, excuse my French, peep, right? And so very interesting to look at their trade performance and what they show, what they report, and how good they are, and how they optimize both KPIs, the win to loss and the risk to reward ratios as well. They're not always winners, but they're the most consistent player in the game. Now, to drive this concept home for you, what I like to do is I like to compare the financial market with a poker table. Now, hear me out here, and please don't get me wrong and say, well, this is the second live session and I joined the campus, and what you're doing is you're comparing trading to gambling and to play poker. Okay, this is not what I'm trying to say, okay? Let me repeat, this is not what I'm trying to say. What I'm comparing the financial market to is the poker table itself. And just hear me out. This will make a lot of sense in just a second. So buckle up. All the participants sit on the same table. You have the big banks like JP Morgan Chase, you have Citi, you have Morgan Stanley, you have hedge funds like Elliott or Bridgewater, you have asset management firms like BlackRock and Vanguard, and they're all sitting on the same table. Who else is sitting on the same table? Well, it's us. And we would categorize us as the retail trader. We're sitting on the same table as them. Now, who do you also have? You have grandma and grandpa here potentially sitting on the same table. Now, this is not to be demeaning. It's just to paint a picture that regardless of your age, your monetary assets, your education, your experience level in the financial markets, we all sit on the same table. We all have access to the same financial markets. And the dealer here, that would be the broker. So basically, the broker is the interface between us, the traders, the investor, and the financial market. Now, let's take a minute and compare the financial market to a professional poker tournament. Let's say the Poker World Cup, because essentially that's what the financial market is. It mainly consists of professional participants who are going to be playing the game at a very high level because they're here to stay. If you, for example, look at a professional poker tournament, then you'll understand and see that year after year after year, it is the same or similar groups of people sitting at the same table. Why is it mostly the same? Well, because these people, they know how to play the game. They understand the rules. They are professionals. They're here to stay. And for us to have a chance in the financial market, we first have to understand the rules. We have to understand how to play the game. Otherwise, we're going to, be kicked off the table rather soon. Where else can we find similarities between the poker table and the financial markets? Well, both are zero-sum games. Circling back to a statement that I made earlier, it means that the chips within the table, right, the 9.1 trillion US dollars that are traded within our 4 largest asset classes every single day, those 9.1 trillion US dollars, they're not additionally coming to the table. They're not going off the table. They're on the table and they're just moving around within the table. They're circulating. And unfortunately, most of the time, the chips will circulate from the uneducated and inexperienced poker player / trader, maybe the online poker player that has just started to play, and they will go into a room with experienced and educated poker traders, and usually what happens is they're going to lose, right? And the money flows from uneducated, inexperienced to educated, experienced, skilled, the people that know how to play the game. And the same principle here as applies on the poker table applies to the financial market. Most of the time, you don't have more money coming in or money coming out of the market. Now, there are expectations to that, mainly if central banks intervene, for example, but generally speaking, you simply have money circulating from one side to the other side, usually from retailers to from grandma, and from the retailer to the institutions. Now, let's just say you walk into a casino, and you see Daniel Negreanu, and he's best known as the Poker Kid. If you're not familiar with him, he's a Canadian guy. And let's just assume you're seeing this Poker Kid on the poker table, and you walk into the casino. And if you don't know him, then the Poker Kid, he made 38 final tables in his career. He cashed out 108 times. He made a total of 42 million US dollars in his career. And he went to many, many World Series of Poker main events. And he's also been inducted into the Poker Hall of Fame that happened in 2014. So you see that guy, obviously a professional poker player, the Poker Kid, Canadian guy. You see him sitting on the poker table. And what you're going to do? Now, would you sit down and play against him? Probably not, right? And even if you would, chances are that you would get your clocks cleaned and walk out the casino shoulder shruggingly, right? Now, the financial market and the financial world, it mostly consists of those professionals, right? Those professionals, they're here to stay, and their entire business models relies on them understanding the game and buying and selling at the most favorable prices. We've learned that they're not always right, as predicting the future is difficult even to them, but they are the most consistent player in the game. Now, these were a lot of bad news, right? But now here's the good news. The difference, we've talked about a lot of similarities on the poker table and the financial market. Now, the difference between the financial market and the poker table is that we do not have to play against the professionals, right? The professionals are not the bad guys. They are not the manipulators that we make them out to be, but rather we can choose to play with them. That's our goal, right? We want to be buying when they are buying, and we want to be selling when they're selling, so we can have a piece of their cake as well. Now, on the other hand, what you really want to avoid at all costs is to trade like the conventional retail trader, because as we know, statistically, they are going to lose money most of the time. Not always, but they're the most consistent loser. So choosing sides here is kind of easy, right? Most of you have already participated in the market, right? One way or another. And whether that included, let's say, buying a cryptocurrency, buying Bitcoin, buying Ethereum, or whether that includes buying a stock like Apple or buying an ETF, an exchange traded fund, or dabbling with any other financial instrument. And that's really fine. But from now on, when you participate in the market, we must be very crystal clear on how we're going to do that. There must be clear and objective set of rules on when and how to enter any market. So there are going to be 3 elements that each trade will consist of moving forward. All these elements we will spend some time on individually in just a second, and I'll showcase a practical application here too. But before we do that, let's just look at the big picture here. Okay, so each trade will consist of an entry, a stop, and a target. The entry is going to be the opening of a new position in any market at a predefined price. And the emphasis here is really at predefined, because at the end of the day, anyone can enter any market at any price. What we want to achieve is to enter the market at a favorable, predefined, pre-planned price. A favorable, predefined, pre-planned price, where we choose beforehand, that's where we enter. The stop and the target will be the closing or the exiting of an open position, also at a predefined price. So this would then result in either a loss or a profit, depending on whether price hits the stop loss, or the target price. Now, to set those predefined trade parameters, or in other words, to set entries, targets, and stop losses, we really need to know when and where price is most likely to turn, right? We need to be able to predict rallies and declines before they happen, and we need to have a way of timing the market with using our trade parameters. And all of that we will cover, I promise, but first things first. So first, let us cover the prerequisites of the strategy, because as you'll find, the set and forget and get a live approach comes with a unique set of benefits. So let's start with the most obvious element of a trade, the entry. The entry is defined as the opening of a new position in any market at a favorable, pre-planned, predefined price. Benefits include increased profit margin Of course, that makes sense, right? The lower or the cheaper you can buy, the better. We want to buy only below the current price. We will not chase price, because chasing price most often than not comes with buying high and selling low. Right? We want to do the opposite. What we want to do is buy low and sell high. So automatically, we will look below the current price to buy. Then we would place our entry, let us say, on a specific chart. We could place our entry below current price. Now, let's not get too confused about this chart right here. What it basically tells you, and we'll get into that in a little more detail later. What it tells you is it's price moving from left to right throughout time, right? And you see different so-called candlesticks, and all those candlesticks, they represent a certain time period. All of that is not so important right now. What is important is that you see the price flow throughout time, and where you see the current price is right here, and you see that moving. We're live at the moment, and I'm looking at the Nasdaq. So the current price of the Nasdaq is 12,100 points, roughly. And that's the current price. So what I want to do is I want to place an entry not above current price, not at a higher price, right? Because that would be kind of insane. I would be buying high. What I want to do is I want to buy below current price. So let us just assume we're now going to place an entry. Just hold on for a second. I'll make it the same color. All right, so let us assume we're now going to place an entry at the $11,181 mark. That is going to be our entry. Also using the same color. Right. So now we have placed a predefined, pre-planned, favorable entry. It's favorable because as price moves higher, we are potentially making more profit, right? Because we're buying cheaper. And so it's a favorable, predefined, pre-planned price. Another advantage that would come with that, and let's go back to the slides. I still have this open. Another advantage that would come with that is, of course, emotions, right? Emotions do not get in the way. We keep our emotions in check, especially during turbulent market times. One of the strongest emotions in trading I found is FOMO, or fear of missing out. And we can only begin to control this emotion if we are crystal clear with the way we're going to enter the market. We only buy below current price and we sell only above current price. And we abide by those rules like a religion. Now, what about time? Not having to sit in front of the screen to manually react on a scenario. Yes. Now, don't get me wrong. I love trading and I love spending time in front of the screen. However, there's also other things I love and enjoy doing, like spending time with my family or building businesses. And the reality is, while I can look at the screen all day, right? You cannot spend all day in front of the screen unless you're a full-time trader. But you have to find a way to minimize your screen time. And the only way to minimize your screen time to cater for your otherwise busy lifestyle in terms of job and relationships and family and other hobbies that you may have is through the set and forget approach, and by entering pre-planned, predefined, favorable entries. Now, the second element of a trade is the stop loss. Now, the stop loss is defined as the closing or exiting of an open position at a predefined loss. Rule number one, and the first golden rule, one that is not debatable: placing a stop is mandatory. And I also tell you why. A predefined stop allows us to take calculated risk. Calculated risk, in other words, is a way of managing risk, as we need to become good money managers, right? That was literally first slide, lesson one. A good trader is a good money manager. So how do we become good money managers? Well, we need a way of timing the market. As part of timing the market, we have our stop loss, because as it stands, let us say price is coming into our entry. Now price is here. Now we would be in this trade. We would be filled at 11,000. As price continues to go lower, the more money we're losing, right? The more money we're losing. So this could be not infinite, right? Because it would only go until something is at zero, and most of the time stocks will not go to zero, right? Most of the time. However, the further this goes down, the more you'll be losing. So there's no calculated approach here. Vice versa, the more this goes up, of course, the more I make, right? So this calculation of, yeah, I know it can go down, but it can also go up. Well, but what if it doesn't go up, right? What if it goes down? What if we are wrong? Because we can't be right all the time. We know that Goldman Sachs, they're only right. Well, only, right? They're not always right. Even they are sometimes wrong. But what they really have an eye on is they have an eye on risk to reward, right? For every dollar they risk, they make X amount, at least X2 amount of the dollars they risk. So what they do is they limit their risk by moving a stop loss. And to not have a stop loss here, but to potentially have a stop loss that's predefined and objective here, right? So they're moving their stop loss so that now they're achieving a calculated risk and they're minimizing the stop. And they may be maximizing, you could really see that in the last 3 months trading performance, they're maximizing their reward potential. So reward is already, I'm already stepping ahead a little bit here. So let us remove that, the green part, and let's now put in a stop here. Okay, so now we're putting in a stop loss. And let's just say that's going to be our stop loss. So what we now have is we have a predefined entry and we have a predefined stop loss. That means I can enter a trade with a predefined risk. Now the question is, of course, what is the risk, right? Now, of course, you could say, okay, here we go. So of course, the risk would be, you would say, well, it's from 11,181 to 10,689. So that would be roughly 500 points or dollars, right? Which is 11,200 to 10,700 roughly, right? Would be $500. So that would be a risk in terms of the dollar amount here. But what we can do with our risk, it's an X, it's a 1X. It's variable, and it's always a constant, right? It's always the same. So we always risk whatever our risk requirements are. This could be $100, this could be $200, this could be, for a more experienced trader, $1,000, and so on and so forth. So if this is our risk, now all of a sudden, let's decide that 1X in this case is we want to risk $100 on this trade. Now we know in advance price is coming down. Now we're in this trade. Now we know it in advance. What's the worst case scenario? The worst case scenario is price is stopping us out. And if it's stopping us out, and if it goes to 9,000, we don't care. We only risk whatever our predefined stop loss parameter, this trade specifically here, to risk. And in this case, it would be a calculated risk of $100 is all we can lose in this trade, even if price goes to 9,000. Before we go to the target here, of course, is getting stopped out okay? And I think that's an important question that I almost overlooked, and maybe take a minute to answer that question for yourself. Take a few seconds. I know you already can see the answer here. And the short answer is yes, of course, getting stopped out is okay, right? And I actually don't really like the word losing and winning, because at the end of the day, we're not playing a board game, right? And let's say you open up a coffee shop down the street, and on top of your initial investment, then you'll have monthly running costs such as coffee beans, you need produce, right? Then salaries in form of waiters and baristas, and maintenance costs for your machines. And then of course you have rent, and maybe you want to have then also a delivery service on top. And you can see that the costs, they just stack up and up and up. And for any business around the world, that's just perceived as normal. But when it comes to trading, all of a sudden losing trades is a bad thing, right? Now, what we need to do is we need to rephrase that a little bit and think of the losing trades as a form of a variable running cost in doing this business. And in fact, it's the only cost that we have on top of the initial cost that you may have in terms of getting this business of yours up and running. That may include equipment, that may include education, that may include mentoring, that may include getting the right software, right? Those would be your initial costs to set up this business. And then you may have a variable of running costs. Those may be your losing trades. And at some months you may have more, and some months you may have less. But as long as at the end of the month, and in the end of the quarter, and at the end of the year, you have more revenues than costs, you are running a profitable business, right? Coffee shops, they are not always visited by the same amount of people all year round. They have their seasons, right? In the summer, maybe a lot more people go to coffee shops. They sit outside, they drink more coffee, they eat more cake. And during the winter time, when it's cold, no one really wants to go out. No one really wants to go sit outside the coffee shop. And so that business would be seasonal. And so during some seasons, they make more money. During some seasons, they make less money. And so you as a trader as well, you'll be seasonal. Sometimes you make more money, sometimes you make less money. You can't make this exactly the same amount of money every year. You're running a business. There are a lot of variables. But as long as at the end of the month, at the end of the quarter, at the end of the year, you have more revenues than costs, you are running a profitable business. And now with talking about revenues, now what we can do is we can go into talking about the third trade parameter, which is the target. And the target is defined as the closing of an open position at a predefined profit. Now, there are good reasons why, again, placing a target is mandatory. The advantages here also, they range from saving time to keeping your emotions in check. And even multiple targets are possible here. However, what I think is the most important part here is you need a way of measuring whether the reward to risk proposition of a trade is worth you taking the trade. So in other words, you need a way of measuring whether the reward of a potential trade outweighs the risks of a potential trade in terms of its monetary value. If the reward is not greater than the risk, then you will not take the trade. But if the reward is greater than the risk, then you can take this trade. So how that would look like in our trade scenario where we already have the entry and the stop loss in place. Now what we can do is we can place a target. And let's just say our target is going to be, maybe this is not a good color. Our target is going to be right here. Now, if price comes down again, and we're filled, and then price goes up, then with every 500 points or $500, we're moving here in price. So from 11,200 to 11,700 to 12,200 and so on and so forth. Every $500 or points move would be the equivalent of 1x, right? If you remember the Goldman Sachs scenario, then they would have here 25 million, and then they would have a lot of trades where they make here 25 million, and then they would have a lot more trades where they make 50 million, and then they would have a few trades where they make 75 million, and then they even have some trades where they make 100 million per trade. So they're making a one-to-one, they're making one-to-ones, they're making 1-to-2s, they're making 1-to-3s, and they're making 1-to-4s. And most of what they're making is right this here. So in our world, right, for this specific trade, let's color code this. This would be our risk. All right. And this would be our profit. So when we're filled, and price is moving below, then you're in the running loss or eventually stopped out. You lost whatever your predefined risk was, or if price goes up, at this point, you're making a one-to-one, or in monetary value, a one-to-one, risk to reward of one-to-one would result in $100 of profit. And the more price rallies, the more reward you are to gain, right? And so at this stage, you would have a risk to reward of 1 to 2, which in monetary value, by risking $100, would be $200. Now, price goes even higher, right? Now you have a risk to reward of 1 to 3, which in monetary terms is $300. And lastly, because just to complete this exercise, to be consistent with Goldman Sachs scenario, what they have on their annual report and quarterly reports, they go up to 1 to 4. So 1 to 4s, they will be less frequent also for us, right? But they do happen. And when they do happen, it means that for every dollar you risk, you make $4. That in turn means you can be wrong the next 3 times and you're still in the plus, right? And so what we need to do, just like Goldman Sachs does, is we need to have a bell-shaped curve where most of the time when we're winning, we need to be making at least a 1 to 2 or a 1 to 3, right? At least a 1 to 2. This is what we need to make at least. This is going to be also, you'll find later on, the objective measurable target on average. That's all you need to achieve to be consistently profitable in the long run. However, the better you get, the more you may be moving up here, more you may be moving up here, right? So by talking about our set parameters, we kind of transitioned a little bit here already into risk-reward rate, into the risk-reward ratio and the KPI. And that's fine, right? What we're not going to do is we're not going to talk as of now about multiple targets and so on and so forth. All I want you to understand as of now is that there are always these 3 set parameters as seen here. And that's the only way of measuring objectively, hey, what is your risk? What is your target potential? In this case, our target would be here for a 1 to 4, right? We could put a predefined target already here, and we would say, well, if it goes to 1 to 2, I'm out. That's it, right? I'm happy with a 1 to 2. I can live off a 1 to 2 risk to reward. I just gained $200 by risking only $100. I just gained $2,000 by risking only $1,000. I just gained $20,000 by just risking $10,000, and so on and so forth. So to sum it up, right, the exit elements of the trade the stop and the target, they are here to close an open position. So if the stop is triggered, the trade will be automatically closed for predefined loss, our calculated risk. And on the other side, if the target is hit by price, then we're exiting the trade with a predefined profit. So again, here, the exits, they have to be pre-planned. Really helps us tremendously with managing emotions and managing risk and becoming a good risk manager overall. And just so you know, we're not going to be placing those exits, those stops and targets randomly, right? It may have looked very random of what you just saw. It's not going to be random. It's going to be based on a set of rules that we'll go into in detail. But those rules will be built on these set prerequisites. What did we forget? Of course, we forget the forget approach. So by placing a trade in advance, right, and by applying the predefined, favorable, pre-planned set parameters, you don't need to sit in front of your screen. You don't need to watch the charts all day long. You can actually forget about it, and you can spend the time as needed to go to work, to go after your commitments, spend time with your family, to do whatever you're passionate about. I'm sure you'll be passionate. Some of you that are more veterans in the room, you are passionate about trading. So spending time in front of the screen is more like a good thing rather than, oh, I have to spend time in front of the screen. So as soon as you get passionate, it's actually also a good thing to spend time in front of the screen. You'll look forward to it. But the reality is, not all of you have the time to spend all day in front of the screen, right? I'm getting comments here on the side, which is why I'm giggling here. So what other benefits are there? Well, of course, it keeps our emotions in check, right? We don't get married to our trades. We don't get married to the products that we trade, right? I'm not married to Bitcoin. I'm not married to Nasdaq. It does whatever it does. And I trade it when I see a good trade opportunities, right? You get your emotions in check. You're very objective. You act at predefined, pre-planned areas, and you follow your trades rationally. You take rational decisions rather than irrational, emotional decisions. So in the long run, really optimizing this approach is going to be important, and it's in and of itself an important skill to place a good set. And the only way how we can place a good set is by understanding technical analysis. The best form of technical analysis is, again, supply and demand. And later on, we'll have a very long conversation all around supply and demand, where I'll give you all the set of rules and all the processes that you need to complete a full supply and demand technical analysis that will help you to place a pre-planned, favorable set and forget trade. This may be a little bit of a cheesy slide, and we can conclude with this here, that trading is not only about analyzing charts, it's also about the so-called mental game. And mastering your emotions and psychology, getting to know yourself, and keeping those demons at bay is a skill that also must be mastered. And therefore, the overall concept of set and forget and get alive is really important and essential. And I can't really stress this enough. It will guide you throughout your entire trading journey. All set parameters, again, they're predefined. they're favorable for you, right? You buy below current price, you sell above current price. They're favorable. You take calculated risk, you manage your risk. And by managing your risk, you manage your emotions. And the aim is not really to eliminate, all emotions during a trade, or all emotional trade behavior, such as greed and fear, completely. And as a matter of fact, that's impossible. It's unrealistic. And there will always be emotions in play. The better interpretation of set and forget, is not to completely forget about the trade, but to manage the risk and manage the reward and manage the trade efficiently enough so that your emotions after taking a trade rationally, right? After taking a trade rationally, your emotions will not interfere with the decision-making process that you had undergone rationally before, just because you see certain numbers on the screen, whether fear of losing, I don't want to lose money right now, or my risk is $100, but it's already at $50 in the negatives, and I don't want to lose more, right? Or the millionaire overnight concept, where, wow, I'm already at a 1 to 2 risk to reward. I'm already making $200 for sure. Now it's going to go to the moon, right? And we become greedy. And like the old Wall Street saying goes, bulls and bears get fat, but pigs get slaughtered, right? Unfortunately, that's the way how it goes. And with the set and forget, it's not to eliminate those emotions, but rather to keep them at bay and to learn how to master your own emotions. And how do we do that? We do that only by understanding all scenarios before we enter a trade. The fear, to control the fear, is ask yourself, how much are you willing to lose? And don't go beyond that. The greed would be, how much profit potential do you see? Right? And ask yourself that in a quiet, rational moment, not in an irrational moment. So thereby we would aim to eliminate all these emotional trade behavior, such as greed and fear, to potentially get in the way. After all, mental stability in everyday life is a pillar for success as a trader as well. And this is, at the end of the day, essential to make money work for you. Now we're moving into very interesting slides, because now we're talking about the ways on how we can make money in the financial market. And we already touched on that with the practical application that we did, but just to quickly maybe redo that, we'll go through these slides as well. So also covering a little bit of key trading terminology here. So a long position versus a short position. A long position is taking a trade with the intent to be sold later at a higher price. So what you are predicting, you're basically predicting rallying prices. Now, when it comes to shorting later on, we probably need to spend a little bit more time on, because it's more abstract for most people. But again, I'll try to make it really simple as always, and you can always ask questions along the way. So again, what is a long position? The expression, if you're saying that you are going long, or I am going long, I'm looking to go long, it means that I'm predicting the markets will go up and I'm bullish, right? That's why a long position is defined as a position that is bought with the intent to be sold later at a higher price. Now, if you look at this price chart, then again, you see the candlesticks, and those candlesticks we'll inspect later in a lot more detail, or next week, probably more so. For now, it's only important to understand the set and how a long position plays out contextually here by also seeing the candles. And so based on this chart formation, our analysis would indicate to buy this asset here, whatever it may be. Let's say we buy, this is a stock at $20 per share, right? So we open this at $20 per share, but we just place an entry. It's not yet filled. It's not yet triggered. It's not yet opened. It's just an open order that's lingering within the order books. Now we can also see that currently price is at $27. And let's say that's also where our target may be, very close to that at $26. So what this means is current price is at $27. It means we cannot buy right now. We have to wait for price to come back to $20, right? For us to be allowed to buy. After all, we can only go long with placing a trade, with placing an entry below current price. So remember, we're professional traders. We're not going to chase price. We're really going to wait patiently for price to come to us. So we place the entry, we place the stop, and we place the target. And by placing them, we can then let this play out. So now, by illustrating this here with those slides, you'll see how this could play out. So if you can see now price shooting down, at this stage, you would not yet be filled, right? Price is not yet at your entry. Only if price crosses your entry, you would be filled. The trade would be triggered. You are in this trade. It's an open trade. So in other words, your unfilled order has now been filled. And if price now was to go hit the stop loss, you would lose whatever your risk is. In this case, maybe $2, it may be $20, it may be $10, whatever it may be. In this case, if we just use these numbers here, it may be $2. And as we move out, and as we cross the target, again, our open trades, they're now closed at the target price of 26 or 20, 26, $6 versus $2 of risk. That's a risk to reward of 1 to 3, right? I make $6 from 20 to 26, and I'm potentially risking $2 from 20 to 18. So the difference between losing $2 and making $6 is I have a risk of 1 and I have a reward of 3. So your risk to reward ratio is a 1 to 3. Okay, 1 to 3. Meaning for every dollar you risk, you make $3. Now this could be interchangeable variable in whatever you want to risk. You don't have to risk $2. You can risk $200. But the ratio stays the same. So if you risk $200, you make $600. You make 3 times that much, right? So that's the intent here, a position that is bought with the intent to be sold later at a higher price. Now for a short position, there'll be a few slides here, a few rather outdated slides that talk about iPhone 10 and 11, right? But these slides, what they do is they still capture the essence of what shorting is. And that's what it's all about. So don't get confused about iPhone 10 or iPhone 11, right? It's capturing the same essence. So what is a short position? The expression you are going short, or I am going short, or I'm looking to short means that you're predicting the price will go down. You're bearish. That's why a short position would be defined as a position that is sold with the intent to be bought back later at a lower price. So technically, shorting is not the correct term that could be or can be applied to all trading assets. Let me explain this a little bit. In the stock market, using the term shorting when you in fact bet on falling prices, that's correct, right? In the stock market, when you're shorting, you're borrowing shares in most cases from the broker with the intent to buy back to cover at a later stage at a lower price. In the futures market, though, however, you're not trading shares, you're technically trading contracts. And because you're trading contracts, you don't have to borrow contracts to sell them. You would just be selling that contract to someone else that has specific key characteristics. And so in the futures world, the correct terminology here is sell to enter. In the Forex market, you are trading currency pairs. So for example, you're trading the euro coupled by the US dollar, and therefore when you sell something, you automatically always buy something instead. So in return, if you sell something, you're buying something instead. So there's always an interchange between two currencies that are grouped within a currency pair. So here, the correct terminology would also be to sell to enter. Now, what we are going to do, though, to make our lives very easy, because it's also been wildly adapted all over the world. You know, everyone talks about shorting when they look to position themselves into declining prices, and when they bet on or predict falling prices, then everyone talks about shorting across financial assets. We can do that just to make our lives a little bit easier, but just so you know, it's technically the wrong terminology. It only works for stocks. It doesn't really work for Forex. It doesn't really work for futures. It would be selling that market to enter it. Now you may be saying, well, how is it possible to sell if we talk about stocks, right? How is it possible to sell an asset if you don't even own it, right? And so we don't have to overcomplicate the concept of shorting. So let me just explain it with this outdated example that captures the essence of what shorting really means. So the concept of shorting, it works the following way. If you decide to short a stock, you're planning to sell something you do not own. Now, the broker will allow you to do that. The broker will allow you to borrow that stock for a specific price and then return it back later. You can then return it back later, either with a loss if price were to go up, or with a profit if price was to go down. Now, imagine the following real-world scenario. If Frank here on the left side borrows Alex's iPhone 10 for a month, right? Let's say he does that. Now, Alex sells Frank's iPhone to Mike, who desperately wants it, right? And let's say he's selling that borrowed iPhone for $1,000, right? So first he borrows it. Then he sells it because Mike desperately needs it for $1,000. Since he's a smart businessman, he knew that during that specific month, the brand new iPhone 11 would be coming to market. So what happened with the old model when the new version is getting released is it depreciated in price quite a lot, right? So Alex is now going to Tom, who he knows has the iPhone 10 as well, but wants to buy the new iPhone 11. So he buys the iPhone 10 from Tom for $700, which is a good deal for him, right? And now Alex goes back to Frank, who wants his iPhone back, and Alex returns Frank iPhone 10, but is leaving with $300 of profit in his pocket. And that's exactly how shorting would work. So based on this chart, again, you now have a sell to enter, a short. And notice how the current price is below your trade element, sell to enter, your open, your entry, right? So remember, your entry was below current price, and now your sell entry is above current price, because if you're selling, you want to sell into expensive prices. If you're buying, you want to buy into cheap prices, right? You want to buy cheap, you want to sell expensive. You want to buy low, you want to sell high. So if we're selling, we're just turning this picture upside down on its head. And then we have a sell to enter, let's say at $50. What we also need is we need a stop loss, of course, right? And the stop loss would be at $52. And that would mean that my risk here in this scenario is -$2, right? And that -$2 of risk could be anything that you want, variably interchangeable into anything monetary, which then could be $100 of risk. That's what you're willing to risk. So notice current price is still down here. So what's going to happen now is we can see that price is slowly creeping up. So far, nothing has happened yet, right? We still have our entry, we have our stop loss, and we now also have placed our target here, and our target would be plus $4, right? Because $46 is cheaper than $50. And again, you're betting on declining prices, right? You're selling something, you're borrowing something, you're selling it, and then you're buying back to cover at a cheaper price, right? Or you may buy back to cover at a more expensive price, which then ends up in you losing money. So we continue with that. Price creeps up, and now all of a sudden you're filled. And notice this long wick here, right? So you're not yet stopped out. You would only be stopped out if price was to cross the stop loss. If it does not cross the stop loss, you are not stopped out. So now you're filled, the trade is triggered, the order has been changed from an unfilled order to a filled order, and now you can see the price is falling, and with falling price, you're in the running profit, and as price is touching the target, you have now made $4. $4 in a monetary calculation of reward. If you were to risk $100, you're risking -2, you're making +4, which is a 1 to 2, 1 to 2. And so the same ratio could be applied by risking anything. You could risk $1,000. And here you would make $2,000 if you risk $1,000. So shorting is a position that is sold with the intent to be bought later at a lower price. And our entries will be above current price. Here you can see that wrapped up again. I need to remove the drawings. Here you see the summary of long versus short wrapped up in one window. Buying buying is making money with increasing prices, and we're losing money with decreasing prices, of course, right? So our entries are buying entries. We're open the market. We are open we're opening trades in buying and we're closing trades in selling, right? That may be a target or protective stop. The protective stop kind of works like insurance, right? And it allows us to achieve calculated risk, to manage our risk. With shorting, we're making money with decreasing prices, and we're losing money with increasing prices. Okay, so we're selling something right now with the intent to buy, to cover later on, right? And if price goes down, great, we make money. If price goes up, not so good, we lose money. Let's say now we're looking at gold. Right, now we're looking at gold. And again, don't worry about all those candles. You can see this is live. This should be moving. We see price flow from left to right over time. And what we now want to do is want to look at current price. And now we want to look to sell. We're shorting this. We believe that price in the future is going to go down. So we need to short this. Where do we short this? Well, we want to sell or short above current price, right? Notice how before I looked below, now I'm going to look above. So now we're going to short above current price, right? And let me just do that real quick. So now let us say we have an entry right here, entry to sell short. That's above current price. And we have a stop loss right here at 2062, while the entry is at 2000 roughly right here. So that becomes our trade, right? That becomes our trade. Now, in terms of what the risk is, now the risk could be anything. Let's change that. The risk again could be anything, right? Of course, this is a $55 or point level in gold, but your risk does not have to be $62, right? Your risk can be 1x. It can be anything. So for example, you can risk, let's say now you're more of an advanced trader, you're going to risk $1,000 on this trade, right? So if price now comes up, if price is going to come up, nothing is going to happen until price crosses your entry. At this point, your unfilled entry would be filled, your trade would be triggered, you're in this trade. Now, two things are going to happen. Either price is going to continue to rally, okay, or price is going to drop. And in this case, with declining prices, you make money. With rallying prices, you lose money. Now, what we did already with our stop loss is we're taking a calculated trade, right? We're minimizing our risk by taking calculated risk, and we're managing that trade, right? By taking a stop loss and having a certain risk in place that we're willing to undertake. And as it comes to the target, that target we want to be further away than our stop loss, because we want our reward to be greater than our risk. So as we now go into the reward, now as price declines, you'll see that the more price declines, the more money you'll make in terms of risk to reward. At this stage, you're making a 1-to-1, and a 1-to-1 would apply that you're making $1,000. Now, the further price drops, the more you'll make. Let's say price is going to go even further down. Now, at this stage, you're making what? You're making a risk to reward of 1-to-2, which in monetary, by risking $1,000, you're now making $2,000. And if price reaches the target, if price reaches our predefined target, then you're making a risk to reward of 1-to-3, which in US dollar monetary amount would be $3,000, right? And what you're seeing is that we're managing our risk by minimizing and having a tight stop loss. And we're trying to let the profits run, but we're not going to be super greedy, right? And we're going to work around 1-to-2s, 1-to-3s, sometimes 1-to-1s. We're not going to be pigs, right? We're going to be bulls and bears, but pigs get slaughtered, so we're not going to be pigs. And therefore, by taking a calculated trade and minimizing your risk, having a predefined entry at a favorable price, pre-planned, as price comes up, you're entering, and then with declining prices, the more price declines, every move of $55 in gold would represent 1 additional hour. So the more price moves, the more boxes it travels, the more hours you collect. So here you collect 3 boxes, 3 hours. And if 1 box of risk is $1,000, then 3 boxes of reward would be $3,000. So for every dollar you risk, you make $3 of profit. The beauty about trading is that we can really make money regardless of economic trends, right? And market conditions. Markets are dynamic and they move in cycles. They move up, they move down, they go sideways. And as I've just shown you, the repertoire of our tools will allow us to make money with 2 or even 3 of these cycles, right? We can make money in sideways markets by buying and selling. We can make money in uptrending markets by buying. We can make money in downtrending markets by selling. As a result, you'll be a more well-rounded trader. This slide covers is the risk to reward proposition and the ratios in terms of the red boxes versus the green boxes. The green boxes, the reward needs to be bigger than the red boxes to have a bigger risk to reward ratio, right? The reward needs to outweigh the risk. And similarly, on a short position as well, the green boxes need to be bigger than the red boxes. So price needs to decline further away from the entry than if it rallies. So you're capping your risk, and then you're letting the profits run to the downside. And the same applies to the longs versus the shorts. So that would conclude, I think, today's lesson. We spent roughly 2 hours on Trading 101. And next week, we'll go into Charts 101. And here we'll really go into the charts and the candlesticks and different time frames and what they tell us.